Investing in dual currency investment, or in short DCI, is not only meeting your foreign currency needs, but also offering you the potential higher returns than your fixed deposit. You may choose your currency pair from a wide range of foreign currency like Australian dollar, US dollar, British pound, and many more. You can take advantage of the flexibility with tenure as short as 1 week, 2 weeks, 1 month, 2 months, or 3 months to suit your investment needs. Would you like to know how to profit from DCI? First, I'd like to urge you to click subscribe my channel, share and like my video with your friends. Okay, let us start. Dual currency investment, or is commonly called DCI, within the investment circle is one type of financial product that allows investors to invest in two different currencies at the same time. It is a type of structured deposit that is commonly offered by banks, in particular by the affluent market section. It offers investors the potential to earn higher returns through investing in currency-linked options. Dual currency investment is also a type of foreign exchange, or in short we call forex investment, that involves in buying into a currency pair. This type of investment is also understood as a currency pair trade. The idea behind a dual currency investment is that an investor believes one currency in the pair will appreciate in value relative to the other, and therefore can make a profit by buying the appreciating currency and selling the depreciating currency. When investing in DCI, you must pair two currencies together. Investors will typically invest in one currency, such as the US dollar, and then have the option to receive the principal and interest in second currency, such as the euro, sterling pound, Aussie dollar, Sing dollar, or even Malaysia ringgit. Since there are two currencies involved, the investor will determine which one is the base currency, and once determined, the other currency will be the alternate currency, or some banks call linked currency. The return on the investment is linked to the exchange rate between the two currencies. Indeed, you are making a bet on the exchange rate between two currencies. There are two reasons to invest in DCI. Number one, DCI is usually used for hedging against currency risk between the two currencies. In simple words, it allows the investor to protect themselves against movements in the exchange rate between the two currencies. Let's take US dollar and euro as an example. If the investor is worried about the value of the US dollar decreasing against the euro, they can invest in a DCI that pays out in euro. If the value of the dollar does decrease, the investor will be able to convert their investment into euro at a more favorable exchange rate. Sounded hard to understand? Not to worry. Let me explain. I will use the same US dollar and euro example. Let's say you have an opinion that the value of US dollar will strengthen or increase against euro. You want to take advantage of this increase. You will invest in a DCI that pays out in euros, and you invest 10,000 US dollar. For example, let's say the exchange rate at the time you make the investment is 1.00. That means 1 USD to exchange for 1 euro. So if you convert the 10,000 US dollar, you will get 10,000 euro also. If the value of US dollar strengthens to 1.10, it means the value of the US dollar has gone up and the value of the euro has gone down. When you convert your 10,000 US dollar into euros, you will get 11,000 euros. In this scenario, you will get more euro, and this is favorable exchange rate for you. If the value of US dollar weakens or decreases to 0.90, it means that the value of the US dollar has gone down and the value of the euro has gone up. When you convert your 10,000 US dollar into euros, you will get 9,000 euros only. In this scenario, you will get less euro, and it is not favorable for you. So in this way, by investing in a DCI, you can potentially benefit from a more favorable exchange rate and make a profit on your investment. Reason number 2, DCI also can be used for taking advantage of the interest rate differentials between the two currencies. For example, if an investor is expecting interest rates to rise in one currency and fall in another, they can invest in a DCI that pays out in the currency where interest rates are expected to rise. For example, in an environment where you expect the Federal Reserve will increase interest rates, you will choose the DCI that pays out in US dollar. This way, you can benefit and earn from the higher interest rate while also being protected against movements in the exchange rate. After talking about how DCI works, let's look at who the potential customers are to invest in DCI. Like what I have mentioned in the earlier part, you have an opinion about the exchange rate movements of a currency. Though having this opinion, you are cautious about the real movements. So anybody with cautious risk and return appetite and do not mind currency conversion are suitable to invest in DCI. The natural demand of foreign currencies for those who do not mind currency conversion prefer DCI as another choice of investment. They are the people such as number 1, people with family living abroad. Number 2, parents with children studying abroad. Number 3, traders in import-export businesses. Number 4, people with different currencies transactions. Number 5, overseas nationality, for example, those sign up for MM2H program or those with frequent working trips to Malaysia. And the last one, number 6, expatriates working in Malaysia. Next, when a person should invest in DCI. To invest or not to invest, always remember these 3 points. Point number 1, when the exchange rate between the two currencies are expected to be stable or fluctuate within a narrow range. Narrow range means the price difference is not going to be big, perhaps within the range of a few cents only. It is okay to invest. Point number 2, when the base currency is expected to depreciate slightly. For example, if your base currency is pound sterling and during a time last year when GBP was facing heavy sell down that caused a currency slump, that was probably best to stay away from DCI in pound sterling. Point number 3, don't invest if the base currency is expected to appreciate. It is better to exchange for the base currency or maintain holding the base currency and place it in saving or fixed deposit. Last but not least, what are the benefits and risks of investing in DCI? The benefits are, number 1, better conversion rate in the linked or alternate currency compared to the board rate. Board rate also means over-the-counter rate. Benefit number 2, potentially higher yield or higher return than the normal Malaysian ringgit fixed deposit or foreign currency fixed deposit. Benefit number 3, more choices on high yield short-term investment. Benefit number 4, maximize return when foreign exchange is expected to be relatively stable or fluctuate within narrow range. The risk involved with dual currency investment is that the exchange rate can move against the investor, resulting in loss. This can happen because of various factors such as interest rate changes, economic policies, geopolitical events, etc. and etc. And the risks are, number 1, net return depends on the exchange rate fluctuation during the decision date or upon maturity. Risk number 2, the exchange rate risk due to fluctuations of foreign currency market. It may incur loss if you choose to convert the currency received back to their home currency at maturity. It is important to note that DCIs are considered a high-risk investment as the exchange rates are highly volatile and the returns are not guaranteed. It's always important to consult with a financial advisor and understand the risks before making any investments decisions. It is time to say goodbye. Please help to subscribe my channel, like and share my videos, and click the little bell so that you'll be informed of more new video released. Thank you for watching. See you next time. Bye bye.